Where is the gold in Fort Knox? Remember them telling us, oh, it's maybe missing. It might not be there at all. There was going to be a big exploration of Fort Knox to tell us about the status of the gold. What about the U.S. economy? Moody's telling us that we're heading towards recession. I have so many questions about gold, silver, the U.S. dollar, all of it. And we thought we'd bring in CEO of Lear Capital, Kevin Demerit, who is in town. Invited him in the studio because I want to get a real sense of what's happening with the U.S. economy, the U.S. dollar, gold, and silver. Great to have you in the studio, Kevin. Welcome.
Great to finally be here.
Pleasure. So I want to get this out of the way because I want to talk about silver, what's going on right now. I want to get these economic numbers. We got new CPI numbers. We've got inflation numbers. We got the Fed maybe cutting rates. So there's so much happening right now. But first of all, as I said at the beginning, like you and I talked a couple of months ago, there was all of this buzz about the Fort Knox gold. I've talked to members of Congress who still can't get an answer. You as a gold insider, do you have any insight? Like what's going on with that? We haven't heard anything about it.
Absolutely none. I don't have any insight into it. I don't think anybody really does. The last report that I read was, hey, we're going to go, audit this place. And the only auditing, Clayton, that's been done is for purity of the gold for the past 20 years. So the only people that have been allowed to go in and pull out some gold are the people that are checking for purity, which makes no sense because if the gold hasn't moved and you already know the purity, why do you continually check it? Other than that, there's been absolutely no reports about going in and seeing how much is actually there.
President Trump said we're going to go check on it. Elon Musk said we're going to do a live stream from there. Members of Congress have been stonewalled about going inside. They're not even allowed to go. They've tried to call and get meetings there. They're told they can't go. I mean, I've talked to Congressman Thomas Massie about this, Senator Rand Paul. They just can't seem to get answers about it. What would happen if they went in there and found, first of all, no gold? And then what happened if they found gold and then they could reclassify it to maybe like the market rate of where it sits right now?
Well, if they found no gold, the value of the dollar would just absolutely collapse. I think the credibility of the politicians would absolutely collapse because we'd have absolutely no gold. I mean, there's no security backing anything with the dollar at all. And you just lose a lot of credibility because you're telling everybody that it was actually there. If you found all of it was there and you revalued it, today's value would be about $500 billion. You have a $37 trillion debt. I don't think it really does much. If it's not there, it's a big problem. If it's there, hey, look, it's there. We all know what it's worth. We can all do math and figure out what $3,500 an ounce times how many ever ounces are there, what all of that is. But it really doesn't put a big dent in the deficit at all.
So many countries right now are buying up as much gold as they can get their hands on. Central banks, we've seen from China to Russia. You've been traveling the world, I know, and I don't want to tell tales out of school, what you've been telling me, but you've been meeting with governments all around the world who are moving towards gold in a big way. Can you talk about that and what that actually means, both maybe for the U.S. dollar, but also just for investors who are buying gold like me?
Yeah, so two things. Number one, the value of the U.S. dollar has fallen by 27% since 2020. So in 5 years with inflation and so on and so forth, you have the value of the dollar completely falling off a cliff. If you were a central bank holding dollars, would you want to hold dollars that you're holding debt, you're getting 4.5% on your money, but you've lost 27%. You've gone absolutely nowhere. You don't want to hold that. You want to hold something else. So they're selling off U.S. dollars in droves and they're buying gold at a record pace all around the world. All the central banks are, not all, but most of the central banks are selling huge amounts of treasury bills and then purchasing gold with it. So what does that mean? Central banks are not hedge funds. They're not day traders. They buy the gold and they typically hold it for 7, 10, 15 years at a time. The last time we saw this type of buying was in hyperinflation that we had in the 70s, and you saw central banks buying at record paces. So if we know that those central banks are going to purchase, they're going to hold for long periods of time, and the record buying continues to happen and the selling of treasuries continues to happen, that's why you're seeing people like JP Morgan looking at gold at $6,000 an ounce in the next 4 or 5 years, or Goldman Sachs over the next couple of years at $4,500 or $4,700 an ounce. They know that central banks have more money than anybody out there. They can create it out of thin air. And if they want to purchase some gold at record paces and they want to continue that against a falling dollar, that probably continues over the next 3 to 5 years and pushes the gold price much higher.
So $6,000 an ounce? I mean, where it's right now, I checked this morning, it's like 30, I think it hit a new high today, or right around a new high, like 3,300 an ounce, right?
Yeah. Yeah.
6,000?
Yeah, so they're talking about 6,000 by 2029, 2030. So there's two parts to it. Number one is the central bank buying. Again, it's just the most reliable group that you can kind of count on,
right,
and say, okay, if they're buying with this amount of record buying, that's one part of the equation. The other part of the equation is that here in the United States, we have less than 0.5% of investment assets in precious metals, in gold. 0.5%, to get to 0.5% would push the price of gold, in their opinion, up to $6,000 an ounce, because it would take around 2,500 metric tons of gold to get there, which is 1 year's supply of mining in the market. It's a lot of gold. When you add central bank buying with personal buying or even hedge fund buying into the equation, then you can get to $6,000 an ounce fairly quickly in the gold market. So
25 metric tons of gold, is that what is purported to be at Fort Knox? I mean, is that, because you say like 0.5%, it doesn't even sound like a lot. And when people talk about the gold at Fort Knox, it doesn't even sound like it's that much, but it could move the needle significantly, right? If we had that much gold?
Absolutely. Well, if it wasn't there and you had to replace it, that would push the price of gold to $6,000 an ounce.
Right. On its own, right?
All on its own. So that's what J.P. Morgan is talking about. You don't need much of a shift to just get to 0.5% of the assets in the United States held in gold, which is a fairly low percentage if you look throughout history when you had a little bit higher inflation and a lot of debt. So to get there is not impossible. That alone could push up gold to 6,000. Central bank purchasing could push gold to 6,000. So you've got a lot of different things that could push gold substantially higher than where we are today.
So when you look at central banks, are there any sort of big movements from China dumping US Treasuries? Like, how does that overall going to affect the US economy? Because you're dumping all of these they've been accelerating the pace, to my understanding. You're much more of an expert than I am on this, but they've been accelerating the pace of dumping US Treasuries. And we are in this economic war with China. I mean, maybe no bullets will be fired, but it's really about precious minerals. It's really about the US dollar. It's US Treasuries, and it's this like BRICS currency battling the US dollar right now.
Yeah, so you have two things happening all at once. Okay, so the definition of inflation is too much money chasing too few goods. So if China's selling dollars, those dollars are going somewhere. If you're selling the treasuries, those dollars are going somewhere. They're typically repatriated back to the United States. If they're repatriated back to the United States, that's too much money chasing too few goods, so it's causing inflation. If everybody liquidated dollars outside the United States and they all came back into the United States, then we have all this money chasing too few goods.
Yeah.
That's inflation. At the same time, you have them swapping those dollars for gold, which is an inflationary hedge. So you have this vicious circle starting to happen, which is, we're selling the dollars, creating some more inflation. The Fed is having a difficult time lowering interest rates because inflation is a little too high, even though the economy is slowing. And at the same time, you have gold getting pushed up, which it should if you have higher inflation. So outside the United States, if this continues, again, that's why J.P. Morgan's talking about $6,000 gold. The cycle that's happening is pushing up inflation in the United States by selling dollars and buying gold to combat that inflation outside the United States. If you get a little bump inside the United States because of the inflation and just that 0.5% increase of people in the United States purchasing gold, $6,000 an ounce.
And I want to get more to, people watching right now want to know what to do with their family and how to hedge this, how to deal with that in the economy. I want to talk a little bit more about that here a little bit later. I just want to sort of set the stage where we are with the economy right now. Because it's kind of crazy. I published something the other day about Moody's and the recession talk. So Moody's comes out with this report that we are barreling towards a recession. And it was amazing because a bunch of commenters were like, what are they talking about? I'm already in a recession. Like, for a lot of Americans, under the last 4 years of Biden, the prices of things skyrocketing. I mean, just buying groceries where they used to spend $70 for their family's groceries, now they're paying $160 for groceries. So things have not gotten better just yet. Prices have come down, I guess, in some areas. under Trump, but for the most part, people are still really hurting. So when Moody's talks about a recession, a lot of Americans already feel like they already are in a recession.
Yeah. So here's the piece of the equation that I want people to really understand about jobs, because jobs with wages that are above the inflation rate are going to continue to push the economy forward. Below the inflation rate, you're just getting poorer slowly each and every year. And that's exactly what's happening. When I say the dollar has fallen 27% since 2020, it has, but have your wages increased 27% since 2020? Right. For most people, the answer is no. Right. So they have less money to spend on the necessities and so on and so forth. So that's one part of the equation. The other part of the equation is, because of the inflation, companies make less money. They have less to invest into people and wages. So you have this underemployment. And what I mean by that is all the people that were laid off in the pandemic now come back into the job market. They're saying the job market is strong. Yes, there are jobs available, just not at the pace that they were paying prior to the pandemic. So people have taken cuts in their wages. At the same time, they can't keep up with inflation. So you have some group of people where wages can't keep up with inflation. You have another group of people that took jobs. They are employed, so the employment numbers look good, but they're not. It's not at the pace that they were keeping up with. So what does that mean to the economy? Look, if I have less money, I just have less money to spend on gas. I have less money to spend on anything, goods, services, real estate, whatever it is, my mortgage payment, so on and so forth. That's what Moody's is nervous about. It takes people's pay to buy things to push the economy forward, and that pay is starting to pull back a little bit, and that's the part people need to understand. It's the same exact thing that put us into recession in 2008 with real estate. Real estate values went up so high that people's wages weren't increasing at the same pace, so they just couldn't afford it, so you had to get a correction to get it back into line.
So that's at the heart of this Moody's report. It's really about salaries, wages, jobs, where they see a recession coming?
Well, that's a big part of it in the private sector. In the government sector, it's, hey, you've piled on so much debt that you have to borrow $1 trillion, which is the interest payment now.
Yeah, it's
just
crazy.
On the debt.
That's insane.
You have to borrow $1 trillion just to pay interest, which is keeping inflation high, and it's also keeping interest rates high, which is slowing the economy down. You know, lower interest rates and the economy is going to go faster.
Right.
But we can't do it because the interest rates are higher. So on the government side, too much debt. Well, on the private side, actually too much debt as well. I mean, there's an enormous amount of debt on the private side. But the private side just can't keep up with the debt because of wages. And on the other side, the government can't keep up with the debt because you have to borrow $1 trillion just to pay interest. It's the second largest budget line item under Medicaid and Medicare, and it's above the defense spending. So it's a huge item, and how do you get rid of it? It's almost impossible.
It's so weird because I see this Moody's report, and then I think you and I were talking, like last week or 2 weeks ago, I see these other stories where we're in an economic boom. You know, I see people saying, look at these CPI numbers, and liberals' heads are exploding because of CPI numbers and so forth. And so you get this tale of two different economies right now. You get what Moody's is saying, we're heading towards a recession. But then you have other people saying, look, the CPI numbers, this is good. Consumer spending is up, or I don't know. So maybe you can parse the two sides of this for me.
Well, look, you can make a case for anything. Statistics are easy to manipulate. I would side with Moody's more than I would side with an economist that maybe has, some other motive.
Yeah.
If you want to look at the stock market and say, hey, everything's great with the stock market, sure it is. But stock markets climb staircase and they come down on an elevator.
Well, and also stock market does well when 1,000 people are laid off.
Sure.
Right? When Microsoft lays off 9,000 people, guess what? Their stock went up.
Right. So AI is creating some efficiencies that you don't need people for. So yes, there are some more efficiencies there. But if you look at the economy and you look at the wages that need to purchase these goods and services from these companies that are doing well, it's just getting worse and worse. Debt levels on the private side are skyrocketing. Wages aren't keeping up with inflation. So at some point, something has to give. And in 2008, I don't think anybody thought the real estate market was going to crash, except for a few people that turned themselves into billionaires, but everybody else was just kept playing the game. So I can make a great case. The stock market's doing well, earnings are up, the CPI numbers are coming down, but the Fed still can't lower interest rates. I mean, the Fed Reserve are not idiots. They understand that we are in more of a stagnation type of a environment than we are an inflationary or heading into a recessionary environment. So you're stuck. I can't lower interest rates because inflation will skyrocket again. And I can't raise interest rates to combat inflation because that'll throw us into a recession. It's a bad place to be in if you're the Fed.
I was reading on Zero Hedge this morning about the odds makers saying that the Fed is, now the odds makers are pushing, yet absolutely the Fed is going to be lowering interest rates in September. So you see all of this. People, and these odds makers have been right, that it comes September, the Fed is going to lower interest rates. But, you know, the Fed is quiet. They don't say a word about anything. So do you think we're going to see an interest rate drop in September? And then if we do, what does that mean?
I think you will see an interest rate drop. I don't know if you're going to see a dramatic drop in rates that people really want to see, which is the mortgage rates. So the Fed can drop interest rates, but that doesn't mean mortgage rates and things like that are coming down. Because if you go out and talk to the mortgage guys, they're like, hey, these rates are probably going to stay, or they might even increase a little bit. So the Fed can do whatever they want. People have to realize what the Fed is thinking about. They're thinking about jobs, so they probably want to lower interest rates. But they also think about themselves. If I lower interest rates in a stagflation type of environment, which is basically the economy is slow and inflation is fairly high, that's what the government needs. Wouldn't you want to pay back dollars with dollars that are worth a heck of a lot less? You have a $37 trillion deficit. And if I have an inflation in 5 years, I'm paying back that debt with dollars that are worth a heck of a lot less.
Right.
The government has a couple of options. They can default on the debt, they can inflate it away, or they can pay it back. I don't think anybody believes they're going to pay it back.
No.
They're probably not going to default on it. So all the governments continue to print money, create the inflation, and pay back with lower value dollars. So if they lower interest rates, it's working to their advantage, not ours as investors.
Well, and we just saw this past week a new record, $37 trillion in debt. And I mean, we just passed that threshold. Now it's about $22 billion per day that we're adding to the net. $22 billion per day. I mean, is it sustainable in any kind of way?
Absolutely not. I mean,
it's so phony to me in my brain. Like it almost sounds fake. 37 trillion, and then you brought up the interest payment alone is now over $1 trillion. As Elon Musk has said, I mean, we're going towards a collapse here. We need a total reset.
Yeah, you need a reset. We need a recession to reset the economy. I mean, people don't want to hear that, but that helps reset the economy, where we can lower interest rates and we can get some of these, bad issues under control.
Yeah.
But there is no central bank around the world that believes that the government in the United States can get this under control. Otherwise, they wouldn't be selling dollars. You'd be accumulating dollars if you thought the economy in the United States was going to skyrocket, but that's not what they're thinking. They're thinking inflation is probably going to go much higher, potentially because we just have to keep printing money, $1 trillion, just for interest payments. Interest rates go down. Inflation goes up, they have to raise interest rates again. What's that going to do to the interest payment? It's going to put it at 1.2 trillion, 1.3 trillion. The deficit is supposed to be 50 trillion potentially by 2030. So now all of a sudden we have a $1.6 trillion interest payment. So you have central banks selling dollars that are putting more dollars out into the economy. Every time the government prints dollars and they sell dollars back, the value of your dollar continues to fall. Right? The government prints up $1 trillion, the value of the dollars that are already out there go down a little bit. They sell off dollars, the value of the dollar is going to go down some more. So I just think it's a vicious cycle, and somebody needs to step in. And I thought, Trump and Elon may, wrap their arms around this thing and squeeze real hard and get some politicians to say, okay, fine, we need to fix this situation, but nothing's happened.
Well, it seems like these international bankers are the biggest criminal cabal, in the world. They run everything. And so you're up against this massive beast. I thought maybe that, Trump would come in and end the Fed. Yeah. That's not going to happen. He's certainly been pushing in different directions on that, but there's still an unelected body that's driving financial policy in the United States, which is crazy to me. They're able to print all of these additional dollars, which gets us into these foreign wars. If you didn't have the ability to print all the fake dollars, we wouldn't be in 9 wars around the world. We'd actually have to account for our dollars. So, I mean, where is the U.S. dollar right now? And I want to talk then silver and get into some of that side of it. But where do you think the U.S. dollar sits right now, like on the global scale? We talk about, well, it's losing its reserve currency status. You talked about it declining significantly. Countries have been dumping the U.S. dollar and moving towards local currencies, BRICS currency. So where do you see the U.S. dollar in the next few years?
I think we are one or two major events away from losing the status. There's been 7 world reserve currencies in the history of the world. The other 6 all failed the same way that we're headed with the U.S. dollar, meaning for the first 50 years or so, they did okay. I mean, from the start of the United States up until 2008, we accumulated $8 trillion worth of debt. And from 2008 to 2025, we accumulated another $29 trillion. If you look at, there's a book out there called The History of Money. It's probably the most boring read you'll ever, it's dry as, but what you realize is every one of the major currencies fell off because of debt and one major event. So if you just go back to the last major currency, which was the British pound, it was doing okay. And then all of a sudden they just started printing like crazy. Their deficit was going through the roof and the event was war. After the war, they lost their reserve currencies, world reserve currency status, and we took over. Every one of the other 5 currencies, world reserve currencies, all happened the same way. It was an event that took place because of huge amounts of debt, and it shifted to somebody else.
Roman Empire, British Empire, United States Empire.
Yeah, every one of them, it's all about debt and some event. So I don't know what the event is, but that's what politicians don't understand. They ought to go out, get the book, read it, and say we need to get debt under control, because debt with one big event, one big inflationary event, a war event, something, all of a sudden there's a different currency out there. And the currency that I think is going to be is something that looks like BRICS, because they're backing it with gold or some commodity. I mean, think about it. In the United States, we had to purchase some gold every time we printed dollars up until the 1970s. It was backed by some portion of gold. So we printed some dollars, we had to purchase gold. That kept the printing under control. If you have a world reserve currency that allowed for that or had that feature, then everybody would feel much more comfortable that, hey, that currency is going to hold its value. Are you going to weaponize it? If there's 5 or 6 countries behind it, probably not. It's not just one country. You have to get all the countries to, the U.S. has been weaponizing the dollar, and another problem. But that's where I think we are, 1 or 2 events away from losing the world reserve currency status.
Let's talk about silver. We talked about gold hitting $6,000 an ounce, or that's the projection by J.P. Morgan by 2029. But we talk about on this show all the time the importance of silver. I mean, Elon Musk has been hitting beating the drum about silver. We know the investments that Tesla is trying to make, because how important silver is for, solar panels, for everything. God, for weapons, for crying out loud. And silver is like evaporated once like a weapon goes off. So it's like you're not getting that silver back, right? So it's relatively inexpensive compared to gold, but I don't think people understand how valuable or important silver is. And so many people have been saying it's the most undervalued mineral out there. I'm a big investor in silver. And in fact, my kids, you helped my kids start investing in precious minerals. I'll be totally honest about that. So Kevin and his team at Lear have helped with their IRA. So investing in silver, investing in gold, but specifically silver because it's less expensive. So what don't people understand about silver right now?
Well, I think the silver is just a math equation, and I don't think they're thinking about the math equation in the right way. It's not a hard investment to understand. It's just, I think people look at it and say, hey, gold and silver have just been around a long time, and you got Bitcoin, you got all these other things out there. But silver today, Clayton, has a 200 million ounce deficit. So they need to figure out how to make up a 200 million ounce deficit. And you and I had this conversation.
Where's that deficit? Like who needs it? Who's saying, hey, we're in a deficit, we need this silver?
Mostly the solar industry. So the solar industry in 2018 used to eat up about 4.5% of the silver supply. Now they eat up 17.5% of the silver supply.
And growing.
And growing. So by 2030, they believe that they will be somewhere in the neighborhood of 25 to 30% of the silver supply. So you have this 200 million ounce deficit. You and I spoke right before the program, and I said, hey, if we were in a 200 million ounce deficit on a widget factory, we'd go build 5 factories to catch up. 200 million of anything's a lot. The problem with this equation is the supply side. Only 20% of silver mines actually mine silver. The other 80% mine copper, aluminum, gold, steel, other metals.
Right.
The silver is a byproduct, so they don't concentrate on the silver. They just get it by accident. So what you're asking is 20% of the market to make up a 200 million ounce deficit. It's impossible. The number is actually impossible to play catch up. And that's why Robert Kiyosaki said, hey, in the next couple of years, you could see silver double. He said it's the most undervalued asset that he knows of. I would tend to agree, not just because I'm in the market, because I can just do math. If we have this kind of a deficit, it's increasing because solar's increasing, and solar's probably not going to go anywhere. The green movement's not going anywhere. And you need silver for solar. You can't make solar without silver. You brought up the fact when the bomb goes off, the silver goes away. Look, they make silver paste for solar. You can't pull the silver back out of that paste. Silver would have to be $120 to $150 an ounce before they could actually reclaim that silver in that paste.
Like recycle it or
recycle it back in. Oh. So it's gone basically until silver hits $120 to $150 an ounce.
Wow.
Solar panels are becoming more efficient. They're becoming more efficient because they're using more silver. So not only are more silver or more solar hitting the market by 2030, they're becoming more efficient by using more silver. So we're just creating more of a problem. So the supply side of the market is crazy. If you just sat down with a calculator and said, okay, can that 20% produce 200 million more ounces? It's literally impossible. So what could we do? Could we build another factory? Which means, can we put more mines around the world
in operation?
The answer is no, because it takes 5 or 7 years to get all the permitting from governments and so on and so forth, to dig a big hole in the ground and using all these chemicals to pull silver out of the ground. So it's 5 and 7 years out. So you can't do that either. So the silver price should be $70, $72 an ounce today. If you look at the ratio of gold to silver, it's usually about 65 to 1. Today it's 92 to 1. To get back to that number, silver would have to go up to $70, $72 an ounce.
I'm just going to look at the gold price right now. So gold price, silver price. Yeah, so gold price today, man, I can't type here. Let's see.
3,500, 3,600?
Yeah, because so gold is, $33.49 as of today, and silver's at $37.94. So you, based on that, would really see like a doubling or even a tripling possibly?
Well, if you took the price of gold at $2,000 an ounce, when silver was $49 an ounce, was in the pandemic, right? That's exactly what it was, $2,049 for silver. So here we are at silver at 37, and it was $39 an ounce. Gold was $2,000. Here we are at almost $3,400, and silver's less than 37, less than the 49. If you took those ratios and just went forward, 2,000 divided by 49, and then looked at the price of gold today, silver would have to be $72 an ounce. It's not. It would have to double to get there.
Wow.
All the while, demand is increasing and supply can't keep up.
And Trump is a big, so he has been, despite all the green bill and all of that, he's still very bullish on on solar, because he sees that as an important component to just the overall electricity demand in the United States right now. We have a massive deficit of electricity for AI and revolution there. And so he'll get up on the podium, he'll kind of slam the Green New Deal, but then he's like, but I love solar, he's like, and I do too. It was powered my whole house, so I appreciate it. He hates wind, but he's really bullish on solar. I keep saying that. But he's also been moving towards with executive actions to try to get more mining back in the United States. So, but you said 5 to 7 years to get some of this stuff online, right?
Well, yeah, it's 5 to 7 years, but you still only have 20% of the mines mining actual silver. So you'd have to have, 15, 20 mines come online in a fairly short period of time to try to make up the deficit. It's literally an impossibility. Around the world, it's an impossibility to make up that deficit in a fairly short period of time, meaning that the price of silver should be $70 to $90 an ounce. So let's call it 65 or 70. I mean, I remember people thought I was nuts in 2001, 2002. Price of silver was about $3.50 an ounce. So think of that. We're up 10 times the amount today.
Gosh.
The price of gold has outperformed the stock market since 2000. And people they're not thinking about this.
Yeah.
If you increase the money supply, you can't get enough of this metal. The market has too much demand for it all at the same time. And silver is another inflation hedge. You have so many positives for silver right now that I would just be grabbing all the silver that I could buy.
Well, I mentioned this at the beginning, or towards the beginning. My kids have been investing. You've helped them do that, and our audience, if they want to connect with you guys, we have a website. If they go to learredacted.com, they can connect with you guys. But I personally have an IRA that I've invested with not only real estate but also precious metals. Maybe you could talk about that for someone who's trying to figure out, like, what do I do in my family right now? Maybe they've sat there, they've got an old 401k that's just been sitting there, and they want to maybe like roll it over. Like, what are the benefits of rolling over an old 401k into an IRA that can invest in precious metals or real estate or whatever you want, really?
Yeah, self-directed IRA. So it's real easy. You get all the same tax benefits that you would holding stocks or any other paper type of asset or even real estate. And you can move it over to a self-directed IRA that can actually buy physical metal. So it's not a piece of paper. You're actually holding the physical metal itself. So you're going to be holding physical silver in there. So what do you get out of that? You get diversification. With silver, I think you get one of the most undervalued assets in the market. It's really hard to find anything that's undervalued right now. And silver is one of them.
That's what Natalie and I just doubled down, and we bought 70% silver in our last go around and 30% gold.
Right.
We just know. I mean, I see the math doesn't lie to me anyway.
Yeah. So you get some diversification. If the dollar continues to fall, if stocks fall, I mean, Warren Buffett has he's accumulated $315 billion worth of cash. The guy's pretty smart, so I would tend to think that he understands
what's coming.
What's coming, and the market's overvalued. So we can diversify. We can put it into something that's going to offset that. In 2008, the silver and gold market skyrocketed when the rest of the markets were falling. So you get this offset with that type of market with all the same tax benefits. And it's just real simple. You fill out paperwork, takes about 10 minutes. We do the transfer. We place the physical gold inside of your account, and then you can track that and follow it and buy and sell it just like you would, a stock or a bond. So real easy to do. And it's a great thing for people to do, especially retirement, the baby boomers, because you're getting to a point where if the stock market falls, in 2008, it took 7 years for the market to get back to even. You just don't have that kind of time. You need something to offset the loss.
And people, that was always made me laugh. People were like, yeah, but now my accounts are back to where they were 10 years ago. It's like, wait, so you lost 10 years of investing time.
Right.
My stocks bounced back 10 years after the collapse. Oh, great. So now you lost 10 years of investing time.
Right.
That's so crazy to me.
Plus inflation. So you lost, 2.5%, 3%. Yeah.
Anyway.
Each year.
And you guys take care of all that for people, by the way. And you also, I think, have a bonus for anybody who's watching right now, right? Can you talk about that?
Yeah, so we have a new special reports, the end of the dollar dominance, and it really goes through the government debt. All the things that we've talked about here in very big detail. So we just don't have enough time here, but it's about a 30-page report that you can go through and just look at what we're talking about. And the last part of it is talking about silver. So we've got that free report, and we also include $500 in credit for anyone who calls. And that credit can be used for all the shipping, insurance, to get metals to actually your physical doorstep, or all of your IRA fees. So there's some IRA fees, and we'll just cover all those IRA fees with that, with that credit. It's upfront. You just call. You just have to mention Redacted, because we only do this for a couple of programs. You're one of them. So we want people to do that if they call or go to the website.
We'll have a link in the description, so if people go to Lear Redacted, I'm telling you, these are my guys. These are Lear has been our whole family is invested now, so we have precious minerals like that we hold off site, but also on site, and and people can do it. They can keep it in their gun safe, but you can store it off site. Actually, can you talk about that real quick? Like, storing it off site, how does that work? Because people are like, oh, I want to hold it in my own gun safe. I want to keep it in my house. But if you've got a lot of it, that's kind of...
Yeah, silver gets a little bulky, so holding it in a gun safe, if you have a lot, can get overwhelming. So we use Delaware Depository. It's one of the largest depositories in the country. It's very secure. We've used them for 35 years now. So it's a great option. And basically what happens is the metal is delivered, and that becomes your third party. It's called a depository receipt. And you get that depository receipt so you know that metal's there. They're confirming that it's there for you.
And they audit it, basically.
And they audit it for you.
They'll send you photos and all of that.
Yep.
Yeah.
And then when you sell, you just give us a phone call. We sell a portion, and you get another receipt to say, hey, we've reduced it by 1,000 ounces or 100 ounces or whatever it is. So they're your third party, kind of make sure that everything's above board.
All right. So bottom line for us, Kevin, do you think we're heading towards like a big recession here? Is it going to be, moderate? What are you talking about with all of the people you talk to on a regular basis?
I think it's hard to say if it's going to be an extremely bad, like a 2008 recession, or you're just going to get a normal recession where markets are going to pull back 20, 25, 30%, and then you've got some time to wait. I'm just concerned with the inflation part of the situation and the amount of debt, because you just can't get around the $1 trillion in printing to cover the interest payment. And wages. Wages make no sense to me today. If people don't start making more money for the general population, there's no money to spend to drive, the stock market higher, real estate, and so on and so forth. So you will get some sort of a recession. And usually those are the worst ones, because to get people back, you get a recession, people get laid off. So the problem gets worse before it gets better.
Right.
So that's my biggest concern, the wage part of the market.
Yeah, and I'm concerned about like the 50-year-olds, the 55-year-olds who then, with AI or whatever else, they get pushed out of the market completely. They lose their job, and then now they're not able to get a new job. They're not able to go back because now their skills are not relevant anymore. AI has taken over their job, and now they're...
Or you're underemployed. You are working. You're just working for minimum wage, or you're working $20 an hour or something.
All right. Kevin DeMerit, great to see you, my friend. Thank you so much.
Thanks for having me.
Thank you for this. I have a lot to think about with this economy now, so thanks for making sense of it. I appreciate it.
Yep.